So I'm Bill Dudley. I'm the chairman of the Bretton Woods Committee. And earlier this month, the BWC Future of Finance Working Group published their latest brief, which explores the opportunities and risk in stablecoins. These digital dollars have grown rapidly to over 200 billion in circulation, and they could be important means of facilitating cross-border payments and other types of transactions. Given that most stablecoins are denominated in dollars, it also means that this could support and strengthen the dollar's role globally. With me today is Dante Disparte, the Chief Strategy Officer and Head of Global Policy for Circle. So, Dante, can you tell me where we are in this journey and how we got here and where we're headed?
Well, first of all, it's great to be back with you, Bill, and indeed, we're very happy to have collaborated with the Bretton Woods Committee on this paper. And so, where we are now, in some respects, is the future is already here, but it is unevenly distributed. That's perhaps one good way to describe this phase, which is that for the better part of a lot of the global regulatory and policy conversations about stablecoins. Many regulators and central bank governors and others have always thought of this innovation as particularly useful in the context of cross-border payments. And so what we have seen at Circle, for example, and with USDC is not only wide adoption at a bottoms-up level. Any individual armed with a basic internet-connected device and a digital wallet that can support stablecoin-based payments has built a bottom-up network. At the same time, we're also seeing growing institutional adoption from companies like Nubank and MoneyGram, just to name two examples, very classical, large institutional players that are also connecting the dots in terms of cross-border money flows.
But what's interesting is that from a global perspective, the approach, at least from the official community, is quite different. I mean, if you look at what the Bank for International Settlements has been working on, they're not really embracing the stable coins, technology for cross-border payments. They're going down in sort of a different track, which I think is sensible if you don't have stable coins as an option. But they probably need to do more in terms of thinking about how stable coins could be part of the solution. If you think about what the BIS is doing, they have this project called Project Nexus, where they're trying to interlink a number of Asian countries that have fast payment systems together. And the idea being if you have a bunch of these things and you link them through a central hub, that makes it much easier to build out to a sort of a global regime. The problem they have, though, is that this requires a viable national instant payments regime. And one thing that's really quite daunting, I think, in this journey is the fact that the U.S. is really nowhere in instant payments. If you look at FedNow or the New York clearinghouse system, their share of payments in the U.S. is de minimis. So you can't really have a global fast payments regime that works well if the national regime doesn't work very well. Now, the BIS has also recognized that there are a totally different track, on technology, and they've Augustine Carstens, for example, was involved in writing a book called the Finternet, which I think is more sympathetic to tokenization, blockchain, et cetera. But still, it's still a more, I think, traditional version of that. What do you think where do you think we need to head, Dante? That in terms of the global effort that we haven't headed yet.
Yeah, and I've tracked a lot of the global conversations, as you know very well, Bill. Including the ones at the Bank for International Settlements and many of their projects. Another example of one of their projects is Agora, which was about using some of these networks with network participants to accelerate settlements between counterparty banks and obviously amongst the central banks as well. And I think one thing that is really important is at some level talking about the tokenized asset, whether it's a central bank digital currency, a deposit token, or a stable coin, would be the equivalent of talking about building a fast train system and train network, but only caring about the engine as opposed to the stations and the stops. And so we don't think of these two types of innovations as competitive with one another. We actually think there's a strong argument around the world for convergence. The more jurisdictions regulate stablecoins and pull stablecoins into the banking and payment perimeter, the more then you will see that the stablecoin leg of a complex transaction or a global transaction can become the medium of exchange that is perfectly designed for internet scale economic activity. And so if a stablecoin network like the one we've helped build at Circle with USDC is an internet of value, then at some level, domestic fast payment systems with counterparty institutions might be the extranet or the intranet. So each of these networks ought to have interoperability at the core. And one of the critical questions that I think a lot of public sector authorities have labored under, including here in the United States with FedNow, is how do we assure the technology is fit for purpose, right? That we're asking taxpayers effectively to bear 100-year technology investments in an environment of money movement that is accelerating as rapidly as it is today. And so I'm of the view that a rules-based regime that promotes bank and non-bank competition and sets certain standards is the better way to ensure that money doesn't just move fast and instantly in a domestic context, but can also serve the entire planet.
Yeah, that's been one of the themes of our digital finance paper series that we need to have regulation that focuses on outcomes, and the regulation could be different for based on different technologies. But obviously, in the stable coin realm, where there are certain issues and risks that still need to be addressed. Can you speak to that?
Yeah, totally. And we agree entirely with the view that in hindsight, many a regulator and many a policymaker, including here domestically with the President's Working Group on Financial Markets historically, or the Financial Stability Board and others globally, looking at potential risks in the emergence of unregulated stablecoins. One of the issues, of course, that matters, you could really bucket them in two categories. One of them are bank-like risks. And to what degree can stablecoin constructs withstand losses of confidence or runs or systemic risk? And what type of spillover effect would that have in the banking system? And more generally, what harms could that cause to retail consumers and holders? The other category of risks that we think is really critical are payment systems risks. So it wouldn't be enough to design a stablecoin and merely care about the bankruptcy construct or the prudential risk categories. You also have to pay equal attention to combating illicit activity, for example, ensuring your stablecoin arrangement isn't co-opted by bad actors and beyond. And so much of the world's regulatory construct, however, in some jurisdictions are enabling passportability of internationally regulated stablecoins into their jurisdictions. Canada, Japan, most recently, the UAE, among others, have established this framework for Circle and USDC. Whereas others are trying to reconcile stablecoin designs against e-money frameworks, which is the prevailing rules that are in place in Europe under the markets and crypto assets framework. And then frankly, the United States remains the outlier, not just in national and federal level crypto and stablecoin policies, but also in having a federal framework for payments amongst the fast country, amongst the advanced economies. And so those gaps need to be closed in order for the United States to remain competitive in this so-called digital currency space race.
So the U.S. has been very slow to provide regulatory clarity. You could argue they provided regulatory and lack of clarity, frankly, not defining what a stable coin is, not defining what the regulatory rules and requirements are, and then only after the fact, sometimes bringing enforcement actions against various players. Finally, it looks like things are changing. So on Capitol Hill, there's legislation now for stable coins that's making its way through Congress. Where does that stand? What do you think is going to happen? What should be in the bills? And what do you think will happen if this legislation is passed in terms of the U.S.'s role in this? Because as we said at the beginning, most of the stablecoins are denominated in dollars. So without the U.S. providing a clear role, this isn't going to go very far.
Yeah. Well, one, we're incredibly encouraged, and it's the Churchillian quote comes in handy when we talk about U.S. policymaking, which is that we will do the right thing when we've exhausted all other alternatives. And as you had rightly mentioned, Bill, I think much of the experience of regulated companies in the United States at the federal level has been wanting and or has devolved into regulation through enforcement. And so the Genius Act, and there's a companion bill on the House Financial Services side called the Stable Act, And if you marry them together, you have a stable genius. Both go very far in really designing a framework that is fit for purpose for the way payments and money and banking work in the United States. Key equities that you have to ensure are balanced at all times are the role of state oversight, for example, of payments companies, where Circle is born, and Stripe and PayPal and many a payment giant have been born from the laboratory of fintech innovation at the state level. But you also want to ensure that there's rules-based competition between banks and non-banks. And the Genius Act even contemplates credit unions, for example, with the NCUA as their primary regulator being able to compete in this digital money movement future. All of that is extraordinary, and it up-levels what has historically been this fintech constitutional crisis to having a federal framework as well. And so as it stands today, at $10 billion, a stablecoin issuer would then graduate to a federal framework. And that federal framework is really important. And the reason why is somewhat nuanced, which is that no state banking supervisor, no matter how big or important the state may be, represents the United States of America at the international bodies like the BIS, the Financial Stability Board, or the Financial Action Task Force. And a company that competes at the type of scale that Circle competes, where we have affiliates in Europe or in Japan or in Singapore or in London and other jurisdictions, is that we need to represent with the imprimatur of US regulatory clarity an export product from the United States of America, not an import product.
So in this legislation, what do you think needs to be done to address the risk of stablecoins? Or, for example, reserving, making sure that if stablecoin issuer fails, that people get their money back, without any delay. What are the kind of protections that you think legislation needs to include?
Yeah, that's a great question. And frankly, on the one hand, we have seen over the last 5 years two categories of teachable lessons. One of them is when a stablecoin issuer, Terra Luna as a famous example, an algorithmic stablecoin that was made famous by making promissory statements on Twitter, what I call the Jerry Maguire test, to show me the money, to then find out that under the very first period of duress, the whole construct failed, and a lot of people were left high and dry. And so if you can't pass the show me the money test, then you don't in fact have a regulated stablecoin construct. And so the bills that are being proposed in Congress would ensure that not only do you have a very conservative reserve structure comprising of cash and treasuries and high quality liquid assets, but that those themselves are guarded in a completely segregated manner from the other money and or cost and overhead of the issuer. And we think that's a very important framework. That should then, of course, be enshrined in bankruptcy law so that the coin holders have preference in any failure across the stablecoin value chain. That, by the way, is the requirement in Europe. Circle's operation in Europe co-locates the reserves, even for our dollar product in Europe and our euro stablecoin, in the European banking system. And so we think a similar regime here is called for, and that's what these bills address. There's also criminal penalties for failing the transparency, disclosure, and auditability requirements of stablecoins, which is also important because it's not enough to say that the money is there and it's safe. You also need third parties to validate that that is in fact the case. And so, all of those pieces coming together, I think allows us to contemplate a world in which the banks benefit, American households and consumers benefit, and then critically, over the long run, the role of the dollar as a reserve currency has these critical features of enjoying innovations into the next century in the same way that we have in the past.
Yeah, this is overdue. I mean, when we started the digital finance paper series a couple of years ago, we basically called out for the need for guidelines, regulations, guardrails, so we could sort of basically get on with the competition between the traditional finance sector and the DeFi sector. And it looks like we're finally going to be able to run that horse race, and we'll see where it ends. Thank you so much, Dante, for sharing those thoughts today. It's really gratifying to me that we're actually finally making progress in this important space.
Indeed. Thank you, Bill.